Hi. Let's learn about excess returns meaning, risk, and formulas. Excess returns are returns achieved above and beyond the return of a designated investment comparison. This can be a riskless rate or benchmark with similar risk to the analyzed investment. Excess returns are important to investors as they gauge performance in comparison to other investment options. Calculating excess return involves subtracting the return of one investment from the total return percentage achieved in another investment. This can be measured against a riskless rate or a closely comparable benchmark. A positive excess return shows that an investment outperformed its comparison, while a negative difference in returns occurs when an investment underperforms. Riskless and low-risk investments are often used by investors seeking to preserve capital for various goals. Excess return levels can be based on comparisons to risk-free securities. For example, if the one-year Treasury has returned 2% and a technology stock has returned 15%, then the excess return achieved for investing in the technology stock is 13%. Alpha is a type of excess return metric that focuses on performance return in excess of a closely comparable benchmark. Alpha is commonly calculated in investment fund management as the excess return a fund manager achieves over a fund's stated benchmark. In general, active fund managers seek to generate positive alpha for their clients in excess of a fund's stated benchmark, while passive fund managers will seek to match the holdings and return of an index. Excess return is associated with risk, meaning that the more risk an investor is willing to take, the greater their opportunity for higher returns. Investors can use metrics such as beta, Jensen's alpha, and the Sharpe ratio to understand their excess return in terms of risk. There are various ways for investors to optimize their portfolios to achieve the most efficient level of excess return over the risk-free rate based on their risk tolerance. Using metrics such as the efficient frontier, capital market line, and capital asset pricing model, investors can choose the level of excess return they wish to achieve above the risk-free rate based on the amount of risk they wish to take on. Here are 5 key takeaways. 1. Excess returns are returns achieved above and beyond the return of a proxy. 2. Excess returns will depend on a designated investment return comparison for analysis. 3. The riskless rate and benchmarks with similar levels of risk to the investment being analyzed are commonly used in calculating excess return. 4. Alpha is a type of excess return metric that focuses on performance return in excess of a closely comparable benchmark. 5. Excess return is an important consideration when using modern portfolio theory which seeks to invest with an optimized portfolio. Hope this would help. Thanks for watching.